Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome back to the Campus Dialogues, a Muslim Views production in affiliation with Muslim Fin. Muslim Fin, your roadmap to Islamic banking and finance. And here to introduce our special guest this evening is my good friend and colleague Siraj Buzik. Siraj?
Assalamu alaikum, how are you doing, Ali?
Alhamdulillah, always good to be back.
Like I say, another week, another episode.
That's right.
And alhamdulillah, tonight we have a returning guest, Abdullah Aziz Davids. If you recall from our previous podcast with Abdullah Aziz, he's the head of research at Kambisa Asset Management, as well as he held positions at firms like Allen Gray and Kagiso Asset Management. And his extensive experience provides a unique perspective on how global events shape local markets and investment opportunities. Abdullah Aziz, welcome back to our show.
Wow, that's a mouthful. Shukran, assalamu alaikum wa rahmatullahi wa barakatuh.
Short and sweet, but
Yes.
we're very happy to have you back. We're quite excited.
Yes.
2025, what's happening in the markets?
Donald Trump.
Yeah.
I was going to say it's all about Donald Trump, but there's been a new entrant for potential time of the year personality, and that's actually a whale called DeepSeek. So we can touch on those things, but I think, the backdrop, and to summarize where we are in markets, the US market was the best performing market last year by a long shot. We're talking about almost 30% returns in the US market. The next best in terms of equity markets was, markets that have done just over 10%. So overall, most, indices and our market barely scratched double digits in terms of returns. And clearly a lot of that came in the last quarter. And if you remember, the US had elections in November. Donald Trump, by landslide, compared to previous elections, he's won that, and he's got a mandate from the American people. And I think that American sort of mandate that he's got, which is, as he says, MAGA, Make America Great Again, involves making US companies great. And as a result, we've seen the US stock market propelling to new highs. And that has sort of trickled down to other markets. But by and large, it's been one story, the US market. And that's sort of the backdrop of our discussion here tonight.
I believe you have an update or presentation with us.
Yes.
Okay.
Yeah, so I think what I wanted to do tonight is really just in a few slides, and it's I know it's it's evening and people, we don't want to bore people with a lot of stats and information. But what I thought I'll do is just from an unconventional source, look at, markets globally and see the impact of that on our markets. Especially given that, this podcast will probably go out before the budget in mid-February. And there's a lot of interest in stuff like the budget in South Africa because it affects the people, the man in the street. It affects how much you take home in terms of your salary, and it affects in terms of what you can do with your salary after you've paid your taxes as well. So hopefully we can keep it short, but also interesting for the viewers. But very importantly, I think, before we can look forward, we need to look back. And as I said, if you look at the last year, the US stock market between 25 and 30%, depending on which market component you look at, be it the Dow Jones index in the US or the broader S&P 500. A lot of that was concentrated. Last year, we spoke about the Magnificent Seven stocks. Lo and behold, it's again those 7 stocks that are driving the market. The Apples, the Googles, the Microsoft, Nvidia is obviously... Tesla was the laggard, but it also in the last quarter, given that Elon Musk is now part of the inner circle, the uncanny reality is that all of Tesla's gains last year happened after the election results. And for the year to date, just prior to the election, Tesla was actually down for the year. And then all of that just changed. And Elon Musk, as we know, is the wealthiest person in the world today. But a lot of that gain came in the literally the last 6 weeks of 2024. And, I just think there's a lot of froth. And, people are hankering on, rhetoric and all of these slogans like Make America Great Again, building the wall and tariffs and all of those things, which makes the world a very polarized atmosphere in the sense that you've got the US and then the rest of the world. Everybody else is scared of tariffs. Everybody else is, looking at how he's going to impact, either their revenues or their costs in terms of lack of revenues or higher tariffs impact him in terms of their costs as well. So that's the backdrop. And, so we've got, in terms of that first slide, which the viewers will see, we look at valuations. And last year in the first podcast that we did, I introduced the concept of a price to book and a return on equity. The price to book effectively is the price that you pay for the assets after all the debt is taken care of. So it's the book value of the companies, or in this case, the indices. And then juxtaposing that is the return on equity. So what return you're making on that book, effectively. And what is noticeable is that the US is an outlier. It's got the highest price to book. It's got a high earnings growth, which is about 14%. But if you contrast that, and I think a lot of what we try and do, and we'll discuss tonight, is contrasting the US with China. And it's comparing NVIDIA to DeepSeek, for example, because I think those are the good sort of poster kids for those two markets. And if you look at the Chinese market, they've got a growth rate of about 11 to 12%, but their valuation is 9 times. So what that tells me is that for you as an investor, you can get your money back in China 2.5 times quicker than what you would get it in the US. So that's the first concept. The second concept is really talking about what is the risk to earnings. And in the US, as we've discussed previously, and what has actually happened last year, is that the Magnificent Seven, those 7 stocks have accounted for the bulk of the growth in the US market. And if one looks at it, they all have one vulnerability. And that vulnerability is that they're reliant on the US consumer, and they're reliant on US corporates to continue investing and spending on 2 things: communications or marketing, or on internet and stuff like ChatGPT and infrastructure. Now, what will upend that market is something like a DeepSeek, which can offer the same product, maybe slightly inferior, depending. And obviously, if you read, the Western media, they say no, it's an inferior product. If you read the Chinese media, they say no, it's a better product. Yeah. So, but be that as it may, the reality is that they've been able to develop the DeepSeek AI sort of engine at a fraction of the cost of what it costed the US guys, the NVIDIAs. And I mean, we discussed some of these numbers, and just to throw those numbers out, we're comparing a $600 billion investment by NVIDIA to a $5.6 million investment by DeepSeek. And, I've got both of these things on my phone. Yeah. You get almost equivalent output in terms of the questions that you ask. But the big advantage of DeepSeek is that they actually give you can see the thinking processes happening in real time. And, thus far the questions, look, I've asked very mediocre questions. But the questions in terms of the output is actually quite quicker than what you see on the ChatGPT and the OpenAI platforms as well. So I think, that's in broad terms, what we're seeing in the market. And then bringing it closer to home, unfortunately, South Africa, we're in a position now we don't have the same tech, we don't have the same sort of opportunity set. But what has happened is that our corporates, they've been quite resilient. So we've seen our market, effectively in 3 categories. You've got the resources on the one hand, that was heavily exposed to China and continues to be exposed to China in terms of the commodities. But a lot of that is now in the base. We've seen commodity prices come down, the platinum prices, the copper price, for example. But these companies are in survival mode, and they've been able to cut their costs. So with a bit of growth, and if China do come back, China has been a big disappointment over the last 2 years, especially given the property issues that they've had. But in a scenario where China shows that they are not there as dependent on US chips or an NVIDIA product, and they can actually sustain their own growth, I think there's a place in the sun for commodity companies. So that's the first level. The second level are these companies that have done well despite issues like load shedding, despite issues like high inflation in South Africa, food inflation, fuel prices have gone up in the past. What we're now seeing is that a lot of those headwinds are turning into tailwinds. So the retailers, for example, we've had over 300 days of no load shedding. Mm-hmm. So they're approaching a full year where they were not forced to close stores or do stuff because of load shedding. So just the annualization of that means that their revenues, and already we've seen the trading updates, revenues are a lot higher. The other aspect is that the costs associated with load shedding, running inverters, running, these diesel sort of generators, for example, that's no longer there. So you're saving on those costs as well. And then the last component is really that the consumer is in a better space as well. I heard a stat that the average salary increase last year was 12.5%. Now, inflation last year was running at about just over 5%. So most people had a real wage increase last year. Again, for that, the annualization of that means that as inflation tracks lower, you're feeling better off as well. You're suddenly going to see that you actually have a bit more money at the end of the month. And we're still in January, believe it or not. But so it feels like it's a 300-day sort of month. But with that, once people get over January, they start seeing the benefit of no load shedding, real wage growth, a better environment in terms of the retail sector. And then the big positive for our market is the two-pot. So that came in September. We discussed it in our previous podcast. And back then we didn't have any stats. So we were groping in the dark and thinking, okay, how is this going to play out? The stats have actually been quite compelling. From the Reserve Bank, they've said that 50 billion rand has already been taken out of the two-pot system. Now, that tells me two things. Firstly, we didn't see a collapse in our equity market. Normally, when people take money out, portfolio managers like myself, we're forced to sell shares because people are taking money out. We haven't seen net outflows. Alhamdulillah, our business have actually continued to grow. Okay. And across the board, I think most fund managers have been able to maintain what they have. So that's a big positive, because the big fear with two-pot was that as people en masse are going to take their money out, you're going to see pressure on equity prices and the equity market sort of sinking. That hasn't happened, so that's the one positive. The other positive is that people have been able to take out 50 billion rand. That's a big number. In our context, that's 25% of our GDP. They've been able to take out of the retirement savings pot effectively without a big impact on that pot. And where's that gone? Most of it, anecdotally, look, we haven't seen the numbers yet, but we've seen retail sales being quite strong, clothing sales. If you look at the Mr. Price numbers, if you look at Cashbuild, they've seen 6% growth in. So we believe that there's been some sort of education that has happened with a lot of pension fund members, where the trustees would have told them, look, you can take your 19,000 or 30,000, but just be careful, because a lot of that you're not going to have in future when you retire. So what people have done is they haven't used it to buy food. They haven't used it to necessarily spend on booze and stuff like that, where it's consumption. Anecdotally, what we think people have done is they've renovated maybe a room at the back, or they've invested so that they can have a future income. So that's by far from the sort of cursory research that we've done in this regard, is where some of that has gone. And then also there has been some pent-up sort of demand in terms of people during COVID and post-COVID haven't really been spending on themselves in terms of clothing and all of that. So we have seen a bit of that as well, which I think is necessary spending. But that trickle effect is quite a big driver of retail earnings in South Africa as well. So at least for 2025, I think we're in a good space, because we're seeing real growth in earnings, we're seeing real growth in disposable income for people. And look, the jury is out whether that can be sustained post 2025. But at least for now, that is a good environment for everybody to be in as well. Okay. So sorry, that is a long story, but a quick summary of the world and where we are locally as well.
Okay, wonderful. I think we can start with the presentation, and then maybe after the presentation, I'll have a few more questions for you.
Okay. So what we've done is, the first slide that we're looking at is global stock market valuations, where, as I've mentioned, we're looking at the price to book. So that's the book value of various countries, and then compare that to the price that you pay for those markets. That's on the vertical axis, and then on the horizontal axis we've got the ROE, the return on equity. And as I said, I mean, the right on the right-hand side of the screen, the US is an outlier. It's the most expensive market on a price to book. Look, it has a high growth rate, but a lot of that growth, as we discussed, rests in the Magnificent Seven. It's those tech stocks that are propelling that growth as well. And what is interesting, and we've just highlighted two areas, Japan, where Japan was in 2012, which is sort of on the left-hand side of the screen, fairly low 1x price to book, very low growth rate in terms of ROE, and where Japan is now, a bit better in terms of both the valuation and the growth rate. But Japan clearly, so the dotted line effectively represents where most countries should be sitting. If they're below the line, they are cheap. If they're above the line, they're expensive. So Japan and China now, and China where they were in 2012, is quite cheap. And even South Africa, I mean, South Africa is there towards the middle of the screen, is quite cheap relative if you look at where the dotted line is. But the two key takeaways is the US and India in particular are still very expensive, whereas places like Japan and China are actually quite cheap on that measure as well. So the next slide is a very busy slide. It's got a lot of numbers. The two key things that I wanted to point out here is that the US has outperformed the rest of the world. If you look at the top section, That's the Americas, and especially the first three lines. That's the Dow Jones Index, the S&P and the S&P 500, which is just the top 500 stocks in America. If you look at the last two columns on the right-hand side, you can see that they've grown. This is just for the month of January. Year to date is the month of January, already 5%, around 5% growth. If you look down the screen, we have started to see the the European markets starting to recover as well. So that middle section, which is EMEA, that's Europe and emerging, the Middle East and Africa. And you can see that some of those countries, we are seeing, almost close to double-digit growth now in terms of those markets. But the laggards has been Asia. So at the bottom there, you can see the Hang Seng and the Nikkei, which is sort of the two markets that are in Asia. They are actually in the red. So they've underperformed year to date. So we think a lot of value is still, in Asia, Asia-Pac. In contrast, the US in our view is quite expensive as well. And in particular, as I've mentioned, this next slide is effectively looking at the last sort of 30 years in the US and see how many companies have actually managed to outperform the average of the index for that year. So last year, the S&P 500 did about 24%. Only about 25% of the companies have managed to grow at a similar or higher rate than 25%, which is fairly low, which tells me that, in broad terms, you've got almost 400 companies out of that 500. They're not growing at all. They're growing much slower than the broader index, which means that the top 100 companies is actually carrying the market. And there's a lot of risk attached to those top 100 companies because of that. And in particular, the top 5 companies, which is part of the Max 7 companies, they've delivered 2/3 of the growth of the index in the last year. And that is unsustainable as well. The next one is a topic we discussed before, but it's also linked to the topic of gold, because this is quite an important discussion. And part of why Mr. Trump has won the election is because if one looks at the US, right, the US is the highest in absolute monetary terms, the highest debt levels of any country in the world. We're talking about almost approaching $35 trillion. That's bigger than the world economy. So the US debt is bigger than the world economy. That tells you something. It's a massive number. And effectively what is propelling that, there's a lot of deficit spending, there's a lot of spending on arms, ammunition and all of those things. But in particular, the acceleration which we highlight in this graph, it took them almost 200 years, over 200 years to get to $12 trillion. It took them 4 years from the COVID pandemic to add another 12 trillion. That is scary. And if that rate continues, it will take them 3 years to add another 12 trillion. And now we're in the realm of $50 trillion of debt. Now, there's 3 implications of that. Firstly, at some level, you can't, the bank is going to say, sorry, you're a bad credit. I'm not going to give you more debt, right? That's the first thing. The second thing is the cost of that debt. Remember, US interest rates went from 0.25% to 4%. So imagine you were paying 0.25% on your mortgage. Now you're paying 4% on your mortgage. That debt has a cost. It's the interest cost. So the US is spending now almost $12 trillion just on interest. That's a scary number. And that number is going to go up for 2 reasons. Firstly, even if interest rate starts going up, the absolute quantum of debt means that you're paying more on your interest. But then secondly, they're not paying back debt. So you've got this phenomenon where you're actually compounding and you're capitalizing interest because you're not covering the full interest bill. So what they do is they issue more treasuries to fund the interest bill. So it's like borrowing money to pay interest. So you're adding to your stock of debt. So that is the 2 reasons why Mr. Trump won, in my view. Firstly, he's promised to cut that, and already yesterday we saw the announcement. He's cutting funding to the World Health Organization. He's cutting funding to USAID, which is quite a big organization that supports a lot of humanitarian causes globally. So that is going to have far-reaching implications for most countries, including South Africa as well, which we can talk about. Sure. But that US debt scenario with the rising interest costs, which we talked about, I mean, you can see in that graph where we are in terms of the blue shaded area, in terms of what they are actually paying in terms of interest costs. It's just breached $1 trillion now. but it's going to increase substantially over the next 10 years as well. And as percentage of their GDP, they will have to spend almost a quarter of their GDP, 20% of their GDP just on interest. And there's a lot of research that economists have done where they say once you get into a scenario where you have to take 20% of your GDP just to pay interest, you get into a debt spiral, because you're not generating enough income to pay interest, which means you're forced to borrow more money to add to just to pay your interest. And that's a scary scenario for the US as well. Lastly, we discussed the Mag 7. Last year, we identified these companies, the 7 companies. And this scary graph doesn't look so scary, but it's a strong growth that we've seen in the Mag 7 in terms of the earnings, over the last couple of years, and projected for 2025 as well. But the next slide, you can see that for next year, so if one looks at the calendar year 2025, their growth is actually coming down. So that red line is the growth rate expected for the Magnificent 7, and you can see it's coming down. Whereas the other 493 companies in the S&P 500 are actually still growing. They're growing at a faster rate. So we see a conversion happening in 2025, which means that these other 493 companies that are a lot cheaper should actually re-rate, and the Mag 7 should start coming down in terms of their rating. When that happens, again, you will see a scenario where the S&P 500 will actually not do well. It will probably decline in terms of its absolute value, as these other companies are not big enough to offset. I mean, a company like NVIDIA, over $3 trillion. A lot of these companies are massive in terms of their size as well. And I mean, in terms of the US valuations, you can see it's added quite a lot. So US valuations currently in terms of a forward PE, the S&P 500, over 20 times. There has been studies that shown that whenever the US market is at over 20 times earnings in terms of their forward PE, the next 5 years of returns are at best single digit, so 3 to 5%. So you're not going to see the 24% that you saw in 2024 repeat in 2025 potentially. I could be wrong, but that's certainly what the history shows. And then lastly, I'm going to terminate on this slide, which is a very busy slide, but basically highlights the various asset classes for the last 11 years from 2013, which has done well. And you can see the US is dominating. If you look at the first couple, the US venture capital, the large cap companies in the US, even small caps have done well in the US as well. So the top 3 places in terms of the best asset classes to be in last year, and for the last 2 years in particular, has been US centric. I mean, South Africa doesn't even feature, and global equity is much further down the screen there. If you look at developed market equities, only 2.4% return last year. So less than 10% of what the US has done. So in summary, the US has done particularly well, mainly because of the Mag 7 in terms of their earnings growth, and then also because of the US being able to inflate the economy through higher debt. But the chickens will probably come home to roost sooner rather than later. That's why we're seeing gold at $2,700. Even Bitcoin has gone up because Trump is a big supporter of Bitcoin. But ultimately, we think that 2025 will be a defining year. Even if it is just because Mr. Trump is president and he's already signed 200 executive orders in the first 10 days of his presidency. So it's going to be a volatile year. It's going to be a year full of surprises potentially. But I think from evaluations, and just bring it back to what we do and what we try and anticipate, our job as fund managers and as investors is to look through the noise. There's a lot of noise in the market at the moment. Is to look through it, look at valuations. And like I said, I mean, China at 9 times multiples, P multiple, it will take you 9 years to get back your money from China. It will take you 25 years in the US. It will take you 30 years in places like India, for example. We're much happier to wait a shorter period in China where we know the base is now low, given what has happened in the property market, and to have a bit of cash also, to be ready when NVIDIA halves again, to be able to buy quality stocks at much lower and reasonable valuations as well.
Okay, that's great. Wow, it's very in-depth. I actually have a few questions for you, but I know that we're going to be running out of time.
Yeah.
Just on the local side of things, how has this land expropriation bill affected, international investments in South Africa?
Yeah, it's an interesting one because that only happened recently. I mean, the president, the bill was enacted by Parliament, but he only signed it into law recently, which is like Monday, I think. So the rand weakened a bit, but the rand has actually strengthened since then again. So look, a lot of the currency volatility over short periods is difficult to ascribe to any one individual event. But you know, the legal opinion we had in terms of looking at that expropriation bill, actually there's nothing to it, because all of the aspects which people might think is controversial is actually in line with the Constitution. It basically says that, you know, there needs to be a fair process, due process. Investors need to be able to look at, or, you know, sellers and buyers need to be reasonable in terms of their demands. And it actually makes provision for legal processes as part of the expropriation. So it's not saying that the government can just expropriate and without fair compensation. And it does allow, let's call it the victims of expropriation, recourse as well, which I think is actually a lot less, you know, controversial and as, you know, negative as many people would have expected. And yeah, I think it's not such a big deal in the true scheme of things. It actually allows for the government also to make use and to start processes to use unutilized land for public good. Yeah. And that's a big theme as well, is the public interest need to be served. So I think, you know, if done properly and with the proper legal framework, it can actually be positive in terms of the economic impact.
Okay, fantastic.
I don't want to sound all gloomy, but looking at what you just showed us in terms of the American market or the US, do you think we'll get to a point where we'll see another market crash? And if so, what does that mean to South Africans and the rest of the world?
That's a good question, because and Monday sort of gave us in Afrikaans they talk about a voorsmaakie, like a teaser of what is likely to happen. And you know, if you look at the market reaction to, and we need to chat about DeepSeek, because you know that's the hot topic at the moment. It had over 1 million downloads on Monday alone. It has been the most downloaded app on the I
downloaded it too on Monday.
Yeah, me too. So I've become an expert in DeepSeek. So the reality is that if you look at the price action on Monday, stuff like utilities and staple companies actually did well. They went up. And the US market went down about 5%. But that's because stocks like NVIDIA went down 19%. Microsoft went down. So you're right, there could be a market crash, but it will be concentrated. And I would like to say that, you know, a lot of us as portfolio managers that don't invest in those stocks will actually be better off, because markets act like a waterbed. You know, when you see pressure on the one side, the other side automatically inflates. And what we've seen over the last couple of years is actually those 7 stocks have had a massive inflationary sort of waterbed effect, to the extent where fund managers and retail investors have taken money out of everything else. So we've seen German equities, we've seen European equities, we've seen Japanese equities coming down materially as people take their money out to put in NVIDIA, to put it in Microsoft, Tesla, all of these companies. So if that reverses, you will see a market crash potentially if it's very quick and severe. But I dare say that these other stocks, because they're quite depressed, they can either be flat or a slight increase. The real risk, and this is a problem with passive index investing. If you look at most global indices, they've got 30 to 35% invested in the Mag 7. So if that goes down 15%, you're down 7-8% in terms of your portfolio. If you've got naught in that, you're not going to see a decline. And that's really, so there could be a market crash, especially if those valuations come down to what we think is more normalized levels. But it wouldn't be broad-based, because like I said, a lot of the other stocks haven't seen the massive rally and rise in their share prices either.
And with all the noise that's currently happening in the market, has there been any significant impact on the Islamic market per se? Have you seen any movement there?
Yeah, what we've seen is that there's been a massive demand for income and anything, you know, related to, you know, security. So, you know, income funds have been the flavor of the month. We've seen massive growth in that area of the market. But then we also have seen a lot of demand for global equity, especially, look, with the US doing what it's done, people want exposure to that. And there has been demand for global equity. But by and large, you know, our community is more risk averse, in general. So they prefer the safety of anything that gives you above inflation return with very little risk or downside. Yeah.
Abdulaziz, we could probably keep going, but we've run out of time again.
Okay.
And I'm going to have to ask again if we can have you back for probably a third
Inshallah.
edition. And we
Yes.
can possibly go into some in-depth discussions around the markets. But again, from our side, shukran so much for availing yourself for the time and for the insights, the global insight into the market.
And just to end off, maybe if you can give us a potential hot stock pick.
Not in video. Yeah, look, a lot of what the investors are looking for are global ideas and global stocks. And, if you look at global investing, like I said, we think that China is very attractive. And in particular, we all know Amazon. We know AWS. We know the Amazon market. To give you a sense, there's a company called JD.com that does exactly the same thing as Amazon. They've got all of those drones. They've got delivery. They've got the platform. It trades on 8 times earnings. Amazon is like on 60 times earnings. So Amazon is 8 times more expensive than JD.com. JD.com has a faster growth trajectory compared to Amazon. So I think, and the good news there is that you can buy it in the US. You don't have to take Chinese yuan or the currency risk there. You can buy it in the US. There's actually platforms in South Africa that you can buy through here locally to get exposure to that type of stock. And if I look globally, South Africa, anywhere in the world, that is probably the number one stock that I would own, not only for the capital growth that you're going to see out of that company, because as it grows, people will say, hang on, this company is not an 8p company, it's probably a 15 or 16, so it can double. It can then double because the earnings growth doubles. Yeah. And then it can double again because it actually has a whole host of investing companies that it invests in, which is about a third of its market value, which it could sell off and pay that back to shareholders as well. It's a very cashless company. So it's the one stock that gives you 3 things, which I call the holy grail of investing. It gives you security of the asset base. It gives you a good dividend in terms of the returns back to you. But it also gives you a multiplier effect of a re-rating plus earnings growth. So Ali, go sell your gold and go buy JD.com.
There you have it, guys, JD.com. And you can only get this information on the Campus Dialogues. And we want to thank you for being here again this evening. And thank you to Abdulaziz for the insightful podcast and market insights. And if you like the show, please like. It helps and supports the channel. Like the video, subscribe, hit the bell icon, and assalamu alaikum wa rahmatullahi wa barakatuh.